Hello guys, I hope you are all doing well. If you're seeing me for the first time, my name is Simo and I'm a junior equity research analyst. Today in this video, I will be presenting the earnings report of Nvidia. I genuinely believe this company will play a central role in the future of the AI industry. In my opinion, even at the current price level, the stock still appears undervalued. Okay, so first thing first, revenue. And look, this is the most important metric for investors. Why? Because revenue is what tells you, and I mean tells you clearly, whether the business is actually growing or not. You can have all the great stories in the world, all the AI hype, all the Jensen Huang presentations, but at the end of the day, revenue is the number that doesn't lie. It tells auditors, it tells analysts, it tells every institutional investor on the planet whether or not things works. So here on slide 2, we have the comparison between Q4 FY25 and Q4 FY26. That's 1 year apart, and you can see it right there on the chart. A big jump up sharply, $39.3 billion last year, 68.1 billion this quarter. That is 73% growth year over year. And moreover, I want you to think about what that actually means in dollars. They added almost 29 billion in revenue in a single year. A year ago, $39 billion felt enormous. Now, $39 billion looks small next to $68 billion. And that kind of trajectory at this scale is extremely rare. Even more impressive, this was the largest quarter-over-quarter growth in the company's history. Not just strong, but record-breaking. Moreover, demand is so intense that even older Hopper chips and 6-year-old Ampere products are sold out in the cloud. That tells you this isn't just a product cycle, it's structural demand. Finally, data center revenue is up nearly 13x since ChatGPT launched. Nvidia offers the highest performance at the lowest cost per token, with the largest installed base. In other words, customers aren't buying hype, they're buying efficiency at scale. And that's a real moat. Let's move on. Okay, so now the data center, and this is the core of the revenue story. This is really where everything is happening. So same structure here. We have Q4 FY25 versus Q4 FY26, and Nvidia actually breaks this into two pieces for you. Compute on the left and networking on the right. So on the compute side, we went from 32.6 billion to 51.3 billion. Big jump, right? Sustained strength in Blackwell and Blackwell Ultra is what they're attributing it to. Blackwell is their newest chip architecture and it is ramping fast. But here's what I really want to point out, and I think a lot of people miss this. Look at the networking bar on the right. Q4 FY25 networking was $3 billion. Q4 FY26, it's $11 billion. That is almost a 4x increase in 1 year in a segment most people aren't even talking about. Strong adoption of NVLink, Spectrum X and InfiniBand. These are the technologies that connect all the chips together in a data center. All right, gross margin. And look, I want to spend a minute here because this slide is deceptively important. GAAP gross margin, so on the left, went from 73% a year ago to 75% this quarter, and on the non-GAAP side, from 73.5% to 75.2%. So up about 2 percentage points year over year. Now, some people look at a 2-point move and say, okay, that's fine, not a big deal. But here's why I think it's actually a very big deal. When a company is ramping a brand new expensive product, and Blackwell is that product, you would normally expect margins to come under pressure first. Manufacturing gets more complex, yields take time to improve, the cost structure needs to catch up. That's just how hardware works. But what Nvidia is showing you here is the opposite. Margins went up as Blackwell ramped, and the reason they tell you is an improved cost structure. That means they got more efficient faster than expected, and the year-over-year improvement came from lower inventory provisions, the supply chain cleaned up. Both of those together tell me this is a very well-run operation. And moreover, a 75% gross margin in hardware is extraordinary. Most chip companies would dream of 55 or 60. Nvidia is at 75. Okay, now operating expenses. So GAAP OPEX went from $4.7 billion to $6.8 billion, up 45%. Non-GAAP from $3.4 billion to $5.1 billion, up 51%. And look, the first reaction you might have is, wow, they're spending a lot more money. And yes, they are. But I want to put that in context for you. Revenue grew 73%. Operating expenses grew 45 to 51%. So they are spending more, but they are growing revenue much faster than they are growing costs. That's called operating leverage, and it's one of the most important concepts in equity research. When you have operating leverage working in your favor, every additional dollar of revenue drops more to the bottom line, and Nvidia has that right now. The company basically says it themselves on this slide, investing to address the multitude of growth opportunities ahead. They see the runway in front of them and they're putting capital to work. I think that's the right call. And this one is really clean and really powerful. GAAP, diluted EPS, went from 0.89 last year to 1.76 this quarter, up 98%. You almost doubled EPS in 1 year. Non-GAAP went from 0.89 to 1.62, and that beat what analysts were expecting by about 5%. The consensus was POL 54, and the tagline on this slide says it perfectly. Top line growth and operating leverage drives accelerating EPS. Accelerating, not growing, accelerating, meaning the rate of growth is speeding up, not slowing down. And I think this is what a lot of investors don't fully appreciate. When you have a company this size where EPS is accelerating, that is an extraordinary signal. Most mature companies at this scale see EPS growth slow as the law of large numbers kicks in. Nvidia is defying that, and moreover, we're talking about $43 billion in net income in a single quarter on a GAAP basis. That puts Nvidia in a tier basically occupied by itself and maybe 2 or 3 other companies on the planet. This is the slide I always tell investors to come back to when they're not sure how to think about a company. Because you can adjust earnings, you can move things around on the income statement, but you cannot fake cash. Cash is cash. Free cash flow went from $15.5 billion in Q4 FY25 to $34.9 billion this quarter, more than doubled in 1 year. $34.9 billion in a single quarter. I want you to think about how extraordinary that is. That is more free cash flow in 1 quarter than most S&P 500 companies generate in an entire year. The machine is working. Now on the capital return side, they returned $4.1 billion to shareholders this quarter between dividends and buybacks. And I want to be transparent here. That is actually down from $8.1 billion they returned a year ago. So the buyback came down. Why? Because they're choosing to reinvest in the business rather than return capital. The slide says it directly, investing for growth while returning capital to shareholders.
In my opinion, that is absolutely the right priority given the opportunity in front of them. But if you're someone who owns Nvidia specifically for buybacks or income, that's something to be aware of.
And this is where it all comes together in one place. Revenue $68.1 billion, up 73%. Gross margin 75%, up 2 points. Operating expenses $6.8 billion, up 45%. Operating income $44.3 billion, up 84%. Net income $43 billion, up 94%. Diluted EPS 176, up 98%. You know what I see when I look at this table? I see a company where every single metric is accelerating faster than the one above it. Revenue grew 73. Operating income grew 84. Net income grew 94. EPS grew 98. Each line is growing faster than the prior line. That's operating leverage in action, compounding from the top of the income statement all the way down to the bottom. In my opinion, a P&L that looks like this at this scale is genuinely rare. I'm talking maybe a handful of times in the history of public markets. For the non-GAAP version of the same income statement, revenue $68.1 billion, same. Gross margin 75.2%, operating income $46.1 billion, net income $39.6 billion, and diluted EPS of 1.62, all up 79 to 82% year over year. And look, I always want to explain the difference between GAAP and non-GAAP because I think it confuses a lot of investors. The main thing non-GAAP strips out is stock-based stock-based compensation, over $1.6 billion this quarter, and acquisition-related costs. Neither of those is cash out the door in the traditional sense, which is why some analysts prefer non-GAAP for evaluating the recurring earnings power of the business. Both numbers tell an incredible story. The non-GAAP 1.62 beat the street by 5%. And there's one thing I really want to flag here. Starting next quarter, Q1 FY27, Nvidia is changing how they report. Stock-based compensation will now be included in non-GAAP results. That's a meaningful accounting shift. What it means practically is that non-GAAP EPS will look a bit lower next quarter than you might expect. If you're just comparing to this quarter, it's not a deterioration in the business. It's a change in the accounting. Don't let that confuse you when Q1 results come out. And this is the slide the whole market was watching. Q1 FY27 revenue guidance, $78 billion plus or minus 2%. Gross margin 75% plus or minus 50 basis points. Operating expenses approximately $7.5 billion. Okay, so here's the honest read. The stock pulled back after hours, and you know why? Because the whisper on the street, what sophisticated investors were actually expecting, was closer to $80 billion. So $78 billion, while objectively an enormous number, felt like a slight miss against those elevated expectations. And that's the reality of being Nvidia right now. The expectations bar is so high that even a $78 billion quarter can disappoint the most aggressive bulls. But here is what I think most people are missing and what I find really compelling. There is an asterisk on that $78 billion guidance, and it's right there at the bottom of the slide. The outlook does not assume any data center compute revenue from China. $0 from China assumed. So think about what that means. If US-China trade relations shift even slightly, if one new export license gets approved, that guidance could prove conservative very quickly. In my opinion, that asterisk is actually one of the most bullish things on this entire slide because it means the upside optionality isn't even priced in. The guidance already has a built-in buffer. Alright, the reconciliation table. I know reconciliation tables are not the most exciting part of the day, but stick with me for a second because there's something actually interesting here. The gap between non-GAAP net income of $39.6 billion and GAAP net income of $43 billion is working in an unusual direction. Normally GAAP is lower than non-GAAP because you're adding expenses back. Here GAAP is higher, and the reason is a $5.4 billion gain from non-marketable equity securities, basically investments Nvidia holds that went up significantly in value. That's a one-time item. It's real money, but it's not recurring earnings power. So if you're modeling the run rate earnings of this business, the non-GAAP number of 1.62 is the cleaner number to anchor to. That's the number that tells you what this business earns on a go-forward basis. Again, the same reconciliation, but for Q4 FY25, the year-ago quarter, so you can do a clean comparison between the two periods. And honestly, this one is more straightforward. Both GAAP and non-GAAP EPS came in at 0.89 a year ago. The adjustments were smaller relative to the size of the business at that time. The key takeaway here is just that the underlying earnings have grown dramatically, not just in absolute terms, but in quality. The recurring clean earnings power of this business is genuinely much stronger than it was a year ago. Now this slide, I want you to pay close attention here because this is one of those details that separates investors who really understand what they're looking at from those who don't. This is the GAAP to non-GAAP bridge for Q1 FY27 guidance. And the number you need to remember is this. Starting next quarter, stock-based compensation is now going inside the non-GAAP figures. $1.9 billion in OPEX, 0.1 point hit to gross margin. That's new. That didn't exist in previous quarters on a non-GAAP basis. So when Q1 results come out and you see non-GAAP EPS look a little lower than the trend from Q4 suggests, don't panic. It's not the business deteriorating, it's the accounting methodology changing. The bridge here is clean. Non-GAAP gross margin 75% minus 0.1 for acquisition costs, lands GAAP at 74.9%. Non-GAAP OPEX $7.5 billion plus $200 million acquisition costs, GAAP OPEX $7.7 billion. Simple. Just know the rules changed going forward. Okay, free cash flow. And look, in my opinion, this is one of the most important KPIs for any business. Full stop, not just Nvidia. Any business. Because you know what free cash flow tells you that earnings don't? It tells you how much real money the company actually generated after paying for everything it needs to keep growing. No accounting adjustments, no non-cash items, just what landed in the bank. So here's what we have. Q4, FY26, operating cash flow $36.2 billion minus $1.3 billion in capex gives you $34.9 billion in free cash flow. A year ago, Q4 FY25, $16.6 billion operating cash flow minus $1.1 billion capex, $15.5 billion free cash flow. Operating cash flow more than doubled. Capex barely moved. And I think that spread right there. That gap between cash generated and cash spent to generate it. That's what makes Nvidia genuinely exceptional from a business quality standpoint. You're running a $36 billion cash flow operation on $1.3 billion of capex. That's a 3.5% reinvestment rate. That is software economics inside a hardware company. And moreover, that free cash flow is what funds the buybacks, the dividends, the R&D, everything. A business that generates cash like this has options. It is not dependent on markets. It's not dependent on debt. It funds itself. That's a very powerful position to be in. Alright, so for my conclusion, Nvidia just had the best quarter in company history, $68.1 billion in revenue, 75% gross margins, $43 billion in net income, $34.9 billion in free cash flow, all records. They guided to $78 billion next quarter with China upside that isn't even in the number. Blackwell is ramping with improving economics. Networking is turning into a $40+ billion annualized business on top of everything else. And they are the most dominant infrastructure company in the most important technological transition of our lifetimes. Yes, the stock pulled back a little. Yes, macro uncertainty is real. Tariffs are in the picture. The Fed is on hold. And the VX is still elevated above where you'd want it to be. I'm not going to pretend none of that matters. But look at the fundamentals. Look at what the numbers just told you. And ask yourself, is this a business you want to own for the next 2 to 3 years? In my opinion, the answer is yes. Near term, I think we trade $183 to $210. The sell the news reaction needs to work its way through. Medium term, end of Q1 into April, I'm looking at $200 to $240, assuming we get through the macro noise. Long-term year-end 2026, I'm targeting $220 to $280. My conviction right now is a 7.5 out of 10. Subscribe if you want me to keep feeding you with videos like this one. Take care, everyone.